All right. Good evening, everyone. Welcome to tonight's webinar. My name is Abigail, and I'm a marketing executive and also a dealer at Phillip Futures. So before I start, can you hear me loud and clear? Let me do a poll, yeah? If you can hear me, kindly select the yes button. Awesome. Okay. All right. Okay, just a little disclaimer before we start off. Whatever we share tonight is just for general information, and it does not constitute any recommendation to buy or sell any investment products. Just a little bit of background here, right? Our mother company, Phillip Capital, is based in Singapore and has a wide global network. We have a business and offices in over 14 different countries. And Phillip Futures is a subsidiary of Phillip Capital, yeah? So why trade with us? First, we offer 24 hours broking and execution support for our clients, which is especially helpful for those trading the foreign markets at night. So you can call in our dealing desk for any help if you need. Next, we also send out latest market news and commentaries to our clients every day through email. And we also provide advisory service on what products you can trade and how you can get started on trading as well. And lastly, we provide a wide area of products that allow our clients to trade from, be it local or foreign products. And other than that, we also provide free one-to-one coaching sessions. This is especially tailored to beginners who are new to futures trading. So you can reach out to us for any appointments if you are keen. And we also conduct free webinars every month, like the one you are joining tonight. And you can check our website for the schedule of upcoming webinars that we have. And lastly, we also offer account opening free of charge. Okay, the platform we use here in Phillip Futures is called Phillip Nova. It is a web-based platform and it's very easy to use. Basically, you can just log in like how you log in your Facebook, and then you can start trading. And inside the platform, we offer over 90 indicators, and we also have live charts where you can place your order from directly. And you can also access both local and foreign products all in one platform. And besides that, we also have a mobile version, mobile app versions for those who are not consistently in front of the computer. And also for those who like to trade on the go, you can download this app, and you also get all the live chart features inside. So yeah, if you are keen to try out our platform, you can scan this QR code and sign up for a demo account to check out the features that I mentioned just now, yeah? All right, before we dive into tonight's topic, I just want to introduce you to our speaker tonight, David Ng. He has done extensive, he has done extensive research and is well versed in the commodity and index markets. He currently trades the Malaysia Index, crude palm oil, and other regional markets. He is well versed in the technical and fundamental aspects of trading. So previously, David was the derivative specialist with a prominent futures broker. In that role, he provided regular comments on the market, like to local media like the Star, Business Times, and The Age. And just before I bring him on board, just to let you all know, later if you have any questions along the way when David is sharing, feel free to type into the question box, because we will have a Q&A session at the end where we will answer your questions. So yeah, without further ado, I will pass the time to David.
Hi, Abigail. Thank you. Just before I start, Abigail, just like to make a sound check. Can you hear me clearly?
Yes, very well.
Okay. Just to check, can you see my screen as well?
Yes, can. Good.
Okay, that's great. Okay, yep. Looks like we are ready to start. Yeah, firstly, just like to thank everyone for coming onto this webinar, especially on a Wednesday evening. So also like take this opportunity to thank Phillip Futures as well as CME to organize and invite me to speak on this platform, especially on this title, mainly on CME Micro E-mini products. If you are new to these products, I think definitely it's worth to try a hands on it, given that we have seen a recent increase in market volatility and we are expecting the market to continue to be volatile in the coming weeks. So it's a perfect timing for if you're new to the market. Hopefully this webinar tonight will give you some insights as well as how you can start trading into this CME comprehensive suite of products. Now, just as usual, to reiterate some of the risk disclaimer. So I'd just like to highlight again that any presentation here today is purely based on my personal opinion. It doesn't reflect any opinion from Phillip Futures or either CME Group. And I think examples here are given are purely for educational purpose. So trading in derivative, especially futures market, do involve risk. So make sure you do consult with a licensed advisor for your next course of action. Now, these are some of the key agenda that we're going to touch on tonight's webinar. So firstly, if you're new to the US market, it's important that you should be aware some of the key economic events and data releases that can affect market sentiment, which is going to affect prices at the end of the day. So as a trader, you are trading this market. It's important for us to be aware, which are the areas or which are the data that is relevant to the market as a whole. Yeah. Abigail, I do receive comment that my line is a bit lag. Could you confirm that? Okay. Abigail, can you hear me? Okay, I think I'm just going to pause for 20 seconds because I do receive some diverse comments saying that my connection is a bit lag. So if you can hear me loud and clear, maybe you can just type in the chat box. And if everything is all right, we can proceed. Okay, looks like things are back to normal. Just to reconfirm, can you hear me for the audience out there? And even Abigail, if you can hear me, can you just please acknowledge in the chat as well? Okay, seems like all good. Sorry for the slight technical issues. I will just carry on our agenda today. So yes, as I was saying, it's important for us to as you are trading the market, is to recognize some of the key events and data that is important for you to trade, especially when you're trading the CME Micro E-mini. Now, obviously, on everybody's mind is, of recent rally they were seeing the US market will continue to go higher. I think that's on everybody's mind. And obviously, just yesterday night we saw a slight correction on the market. Now, is it going to likely to persist? No, probably on the second part of the webinar, I'm probably going to uncover some of the perspective that we can look at, and some of the key variables that we should pay close attention to as these developments will develop further in the next coming months. And towards the end, I'll probably cover on just a simple technical trading setup that you probably can use if you're new to the market to start trading on a CME Micro E-mini. And as a trader, I think some of the key skills that you require to be, to go very long term into a trading business, I think it's very essential to have certain skills, which I'm going to share on towards the end of this webinar. Now, as probably you're aware, if you look at some of the major indices, major US indices, we have seen that across the board, numbers in this year alone is tremendous, it's massive. Just look at US numbers alone. US economy is actually almost on a V-shaped recovery. In fact, certain variables or certain economic indicators are pointing that recovery is in fact higher than the pre-COVID session. So I think January 2021 is a year of recovery. Now, if you just compare advanced economy and emerging markets, IMF earlier this year projected that emerging markets will probably be a better footing compared to advanced economy, but that was not the case. As we head on to probably around March, April, we saw the raging spread of the Delta variant, which actually caused a lot of major economies, especially in Southeast Asia, to be in a lockdown. This included Malaysia to a certain part as well. So, I think IMF has actually revised those projections. In fact, emerging markets seems to be lagging behind advanced economies, especially US and Canada, and to a certain extent Europe countries as well. So there's clearly a divergence between these different countries in terms of their economic growth, and this was partly also due to the vaccine rollout. A lot of these emerging markets were actually on a delayed recovery because there's not much vaccine to be given to these countries. So advanced economies do have a better footing given that they have a faster and easier access to vaccine. As a result, the economy is actually recovered on a very strong footing. So going forward, whether you are trading the market or whether you are just observing the market in general, I think this Delta variant is going to be something that we have to pay close attention to. And obviously, there's also talks in town, recent observation there is a new variant, which is highlighted by WHO, which is a variant of concern. The new variant, which is they spotted certain cases in US. So I think that's also going to be a very close element that we should pay close attention to. Because as this variant starts to rage and it starts to spread, I think countries will indeed going back into a lockdown, and it does affect the economy as a whole. So given that 2021 is a year of recovery, but we see a divergence in terms of the Southeast Asia countries and with the advanced economies, you can start to see PMI numbers are also diverge accordingly. Now the interesting part is that China being the earliest country to get into COVID situation and be the first country to be out of that situation, we can clearly see that PMI numbers are slowly start to shrink, and those numbers are start to decelerate. So this shows that China has been in a very precarious situation. Given that their momentum of their economic growth has actually slowed down tremendously. So do watch out on PMI numbers, because this will indicate whether the economy can continue to grow or whether the economy will start to falter. So given that currently, if you just look at US alone, the PMI numbers are still above 50. That indicate that the economy is still growing to a certain extent. Now, if we just look at world trade, so clearly I mentioned 2021 is a year of recovery as major economies start to reopen. World trade indeed has also shown a V-shaped recovery. In fact, certain countries have way past their pre-COVID levels. But nevertheless, we do acknowledge that the trades are starting to be on a strong footing. It's also evident by Baltic Dry Index, which is an index that measures shipping costs between the region. And you've probably heard over the news that in recent news you can hear that in order for you to ship a shipment from China to US, it will probably cost you 4 times right now compared to probably a year ago. So that shows that we have clearly seen a rise in logistical costs due to the rising backlog at certain major ports. So I think this is going to fit into cost push inflation over time, and that's going to be a recurring theme. Which we're going to discuss later on the later slides. But do watch out. I think again, trade is improving, and this is going to be, as logistical cost is going to be on the rise. This is definitely going to put pressure on costs, especially for producers, and eventually those costs will just have to be passed down to the consumers. So inflation is going to be a theme that we're probably going to see it recurring for quite some time. Now the Delta wave, especially in US, has obviously after the recent reopening of the economy, we can clearly see cases are starting to rise, especially in early parts of June. But those numbers are starting to reach level of peak. In fact, the numbers are cresting as well. So this indicate that despite the rise in cases and rise in hospitalization, cases looks like it's stabilizing at this point in time. So obviously, it does give a lot of assurance in terms of consumer spending. we have to take note that US is actually a very large economy that's very dependent on consumer spending. It's 70% of the GDP is actually put heavy reliance on consumer spending. So without a confidence into the market, if people just doesn't spend, it's going to have an impact on GDP at the end of the day. So with this Delta wave being a bit more moderate in certain sense, I think that's going to create confidence in the consumer market. But it's still early to gauge. Let's see in the next couple of weeks whether are we reaching a level of peak in terms of cases, especially in the US market. Now, as every economy, mobility is a very important statistics to look at because as economy starts to reopen, as states starts to reopen, businesses starts to reopen, definitely your general economy growth is going to be healthy. So you can clearly see this mobility chart. 2021 has been quite a fairly volatile period, and we just ended summer in US. So usually summer is usually where we usually record a very high number of mobility. As people travel interstates, people go into a holiday period. But I think 2021, we saw those numbers is still fairly below the 2019 level, which is the pre-COVID level. So it goes to show that despite we see increasing mobility due to the opening of certain states and opening of businesses, but the mobility as a whole is still pretty much behind compared to 2019. And I think that's going forward, if consumers are a bit more cautious and they are not willing to make the extra spending to travel, I think that's going to have an impact. So businesses might suffer, margins, profit margins may be depressed, and that's going to affect your overall business confidence as well. So again, I think some of the indications are indicating that due to the current wave of the Delta variant, it does have an impact, especially in the US market for the third and probably could extend to the fourth quarter. Or look at the stock market itself, be it the three major US indices, the S&P 500, and even the Nasdaq market. Now, you just look at the stock indices itself, it has actually recorded a tremendous recovery. So what I have here, the bar chart on the left, is to indicate that how long it takes for the S&P 500 to actually double from a bottom low during a bull market. So if you just look at the COVID rally, you can clearly see that it only took 511 days in total for the market to actually double from the bottom low. So indeed, I think this is mainly due to Federal Reserve coming to the market to really push or ready to instigate the market by pumping in a lot of monetary easing measures. So if you just look at Fed balance sheet, we started off before COVID at about $2 to $3 trillion. Now we are reaching a level of close to $9 trillion in just a matter of 16 months, and that's tremendous. So with so much liquidity into the system, eventually this will have to just go to asset markets. And one of the key asset markets that's actually benefiting from such a massive quantitative easing is definitely the stock market. So obviously, compared to previous crisis, economic crisis that's experienced in the US market, I think the fastest recovery in record is still the COVID crisis, which actually only took about 511 days for the market to double up. And if you just look at consecutive days of gains, if you just look at some of the component stocks of the S&P 500, how many of those stocks are trading above the 200 days moving average, which is an indication that whether the stocks is actually on the uptrend or the downtrend. So as long as the stocks are trading above the 200 days moving average, it does indicate that stocks is actually on an uptrend. So if you just look at it, you just look at number of days alone, we are almost reaching the 2004 previous high in terms of the consecutive days where majority of the component stocks are actually above the 200 days moving average. So it shows that the confidence in these businesses are still remain very resilient, and it does indicate that market consensus is still being very bullish at this point in time. Now, just look at Fed balance sheet again. They have pumped so much liquidity into the system, so their balance sheet has ballooned. from pre-COVID levels was about $4 trillion US. Now we are almost reaching at about above $8 trillion US in a matter of 16 months, and that's also tremendous. Now it's not only Federal Reserve. You look at other central banks around the major economies like Bank of Japan. We just look at latest numbers. Their central bank's assets are easily 120% of last year's GDP. European central banks are also similar. So if you just look at, the fascinating thing is that just look at Bank of China. The central bank in China is also reaching almost levels that's similar to Federal Reserve. So it goes to show that as a way to pump up the economy, a lot of these central banks actually engage in monetary easing towards the past 16 months. And of course, during the course, we can clearly see that one of the main major beneficiary of such an action is definitely the respective stock markets. Now, besides having indices that's being on a very strong uptrend, clearly a side impact of the market is we can see rising inflation levels, and it is quite worrying to a certain extent. If you just look at the numbers itself, just this year alone, early part of this year, US inflation numbers were probably between around 3.5 to possible close to 4%. Right now, we are almost reaching to 5% on a general inflation number, and that's showing you a very rapid rise in terms of the overall price environment. Now, if you just look at some of the Fed meetings, Jerome Powell did indicate that this inflation is going to be transitory. It's not going to be persistent because we just came off from a low base. Last year was a COVID year, so a lot of things was actually being priced down. And this year is more of a recovery theme, and therefore, we are coming up from a low base. Now, this inflation number is worth watching going forward. If it is persistent, in a sense that as the few quarters going forward still indicates that the market is pointing to high inflation, eventually the Federal Reserve will just have to step in. And I think one way or the other is to hike the interest rate, which I think if you just look at some of the comments by Jerome Powell, he's hesitating and he really do not want to go to that path that soon. But eventually the market will just have to adjust accordingly for higher interest rate environment, because inflationary pressure is going to be here to stay. If you just look at some of the commodity prices, be it oil market or even in agriculture product, those prices are almost reaching 8 years high or even a decade high. So this price pressure is going to come in and it's going to go into the consumer level. So it's crucial to watch whether Federal Reserve can contain that inflation from going any higher. Okay, and with that, I think there's obviously a lot of talks on whether is US economy risking to go into a period of stagflation. Now, stagflation is actually being defined as a situation in economy whereby we are facing rising inflation environment, and we are also facing a very slow economic growth. Now, obviously, inflation numbers in US has been on a massive run. If you just look at whether it's producer inflation or whether it's consumer inflation level, those numbers are actually reaching 4 to 5 years high. GDP wise, although it did increase, but the growth is not fast enough to cover the rapid rise in inflation, and that's going to be a sign of concern. If you have an economy where you have high inflationary level and economic growth is not fast enough to capture that rise in inflation, that's going to be an issue. So that's where we're going to go into a period of stagflation. You're going to have a stagnant economic growth and a rising inflation. Now, if you look at some of the indication, certain indicators does in fact point us to that narrative. If you just look at some of the economic index or economic surveys by some of the key major businesses, it does indicate that their outlook seems to be a bit more gloomy, to indicate that maybe US economic growth has probably reached a peak, and sooner or later, when it comes to next year, they probably could be a normalization in terms of their GDP growth, and that's a concern. If by then inflation is still likely to persist, and we are likely to see a period of stagflation in the economy, and that's something that the central bank doesn't want. So it's crucial to watch in the coming quarters whether the GDP growth in US is kept sufficiently high, to mitigate some of the effect of inflation. Now, when it comes to unemployment rate, especially when you look into markets, whether it's in respective markets, unemployment rate, especially in US markets, you're trading in US market, is actually being given heavy reliance. Reason being is because we just look at Federal Reserve Jerome Powell comments in recent Jackson Hole meeting. He does indicate that he gave a lot of emphasis on being very pinpointing on general unemployment rate, and he was looking at, he doesn't really give a specific target, but if you just look at historically, whenever you reach current unemployment rate in US is about 5.2%. Whenever you reach about 5% is considered a natural rate of unemployment in US. And once we reach those levels, Federal Reserve tend to indicate that they might start to adjust their policy in regards tightening monetary easing, because that's where the economy will naturally reach its natural rate of unemployment. But what's surprising is that last Friday we have a non-farm payroll report, and that was shocking in a sense that those numbers, last Friday's numbers was actually one of the lowest in 7 months. And I think that was actually partly resulted from the raging Delta variant in certain states in US. It was way below what market forecasted, and I think the market reaction was actually quite instant. So I think this goes to show, I think Federal Reserve might breathe a collective sigh of relief, given that non-farm payrolls was actually way below than estimated. So a lot of, before the non-farm payroll data went out, a lot of people are expecting that finally the taper tantrum or the taper scenario will come eventually, because if you just look at some of the meeting minutes, the previous meeting minutes, Jerome Powell does indicate that he wants to taper by the end of this year. So the question is when, and a lot of market is estimating that he might finally release the taper schedule in this September FOMC meeting, which is next couple of weeks. So I think with last Friday numbers with non-farm payroll coming way below market expectation, I think that's really going to push the agenda further. So at least for now, Federal Reserve might have some room to breathe and may not re-look into the topic of taper, at least for the upcoming September FOMC meeting. November, we are not sure yet. It might resurface the discussion of tapering, but at least for September, I think with such a number from non-farm payroll, it does indicate that Jerome Powell is not very comfortable and is going to continue with the current program. Now, besides unemployment numbers, just look at manufacturing is another good indication whether the economy is actually growing. So obviously, in the first slides, I did show you, generally, if you just look at the global economy, we have divergence, especially in Southeast Asia, or certain countries are actually below their PMI numbers, which is in the contractionary mode, while certain countries, especially in advanced countries, they are showing expansionary mode. So US in a lot of quarters in the past couple of months is indeed growing, is staying above the 50 level. But what is important is that despite we are seeing expansionary in terms of PMI numbers, but investment in capital goods has actually declined. The pace of investments has actually decelerated. So I think this is a sign of concern, because if business is not confident enough in the next few quarters, or they don't see any clarity in the upcoming quarters, they will not want to invest, and that's going to have an impact in your general business environment. So crucially, as we go into heading into the third and fourth quarter of this year, it's crucial to watch whether that sentiment will change. If it doesn't change, I think likely we might see numbers will start to point downwards, and that's going to have an impact in especially in terms of GDP growth. Now, 10-year Treasury yield is been a very interesting market. If you are trading the yields market, I think 10-year Treasury yield has been a very instrumental instruments of late. So if you just look at the 10-year yields alone in US, despite the seeing inflationary environment, and in normal circumstances, whenever you have a high inflation environment, your yield will have to catch up. because the holder of the bonds will really need yield to be commensurate with the rise in inflation, but we don't see that happen. Despite we are being in an inflationary environment right now, we still see the 10 years US Treasury yield to be very low. That's also partly attributed to the QE that's being done by Federal Reserve with 120 billion monthly buying program. I think that's going to push yields to even lower levels. But what is surprising is that if you just look at real yields, currently you're in a negative territory. So real yield means you take the 10 years US yield against the inflation level. So technically you are in a negative trajectory, and that's going to be a concerning, because generally I think there's a couple of points that we can get from here. One of it is either market is putting a lot of confidence that Federal Reserve can control inflation towards the medium term, and therefore yields can remain very low. But I think crucial to watch if US economies, in the next few quarters does indicate there's a lot of does indicate improvement and signs of growth, and inflation is still persistently high. I think eventually you will have to catch up on the higher end. But if we are seeing that those numbers are starting to falter, then we probably could see 10 years US Treasury to hit even lower. So I think that's something to watch out for if you are really trading this market. Now, the reason I point out China is because China being a major partner of US economy, it has a bit of reliance, not in terms of the US economy as a whole, but also the global market. But China of late has been very interesting in the sense that you just look at their numbers, it's pointing you a deceleration in certain variables. And you just look at the growth rate, it's also showing you a decline growth rate. And that's going to have a major impact in terms of whether it's on the US economy or in fact for the global economy. Because when China starts to slow down, the world economy will start to feel the pinch. And if you just look at growth rate itself in terms of the GDP, they have massive numbers for the second quarter. That's because last year it was a low base effect. But those numbers will start to normalize going to third and fourth quarter. So, but what is important, you just look at the chart on the left, it shows that a lot of new orders are actually on a declining phase, which indicates that again, business are starting to get wary and they start to get cautious. And when this thing happens, you really got to see those numbers start to go into weaker numbers. And obviously, you just look at recent articles or even narrative, is pointing to President Xi Jinping's new direction of the economy by giving the team common prosperity, coming hard on a lot of big tech firms in China. So I think that's causing a lot of wariness in terms of investors or the market sentiment as a whole. So China might head into slower growth going forward, and it's just probably a period of adjustment, and that will have an impact on the US market as well as the global market. Now, if you just look at market sentiment as a whole by looking into what we term as a put call ratio, or even the VIX index, we can clearly see market is generally quite complacent in terms of their risk. If you just look at this very high VIX number that is indicated in March last year, that was the height of the COVID-19 pandemic, where we saw Dow Jones plunge almost 20%, 30% to a certain extent, and that really causes a lot of volatility in the market. But if you just look at VIX right now, those numbers are actually indicating to you the market is actually very complacent. Market don't see much risk, and that's where you need to tend to be very cautious, because when market is actually very complacent, and if there's any sharp movement or sharp change in sentiment, it's going to have a major impact. So if you are trading the market, you really have to be careful what's the overall sentiment of the market. Despite market being very complacent at the moment, any shift in sentiment, be it geopolitical risk or be it as we are now in the midst of the COVID-19 pandemic, any change in those sentiment will definitely impact your VIX index, and that will indicate higher volatility in the market. So do watch out. It's good to pay a close attention to VIX index in particular, even for put call ratio as well. So both plays a very similar role in the sense that they do indicate what's the level of volatility in the market. So when those numbers start to rise, it does indicate that the volatility in the market will start to go higher, and that's where, as a trader or you're definitely going to find a lot of opportunities in the market. Now I have this interesting chart here which shows you that partly explains why the recent rally we are seeing in across most of the major US indices. Now, what I have here is to compare the margin debt financing, consumer financing, against the S&P 500 chart. You can clearly see the rising margin debt does coincide with the rise in the index. Now, margin debt is important, especially when you have a low interest rate environment as what you're seeing right now in US. So a lot of consumers are actually piling up on debt, and this debt is actually specifically limited to equity financing. So a lot of people are going to the market by getting in more debt to finance their purchase of stocks. Now, what is interesting is that when margin debt starts to decline, that shows that either market sentiments or consumer belief that market sentiments may start to shift, and they start to offload those debts. So in a way that they will start to close their position or reduce their margin debt. And I think that's also a sign that market could be at peak, could be a point of peakish, because that will definitely deter some of the higher risk taking positions. So you can clearly see, I think those numbers, these numbers was reflected in July. We haven't got the August numbers yet, but do pay close attention to margin debt, because as those numbers starts to decline, it does show that the consumer is actually getting very cautious and wary of the market. So it could potentially signal there's a peak in the market, and probably we could see correction in the market to come. So margin debt is one possible indication that you can probably assess how the market sentiment is generally in the market. Now, besides that margin debt, if you just look at some of the key sectors that is in the US market, you can clearly see there's a shift in some of the fund flow. So obviously, 2020 was a year of big techs. You can see the rise of Apple, Facebook, Amazon, Google, and the rest. So, and 2021 is really a theme of cyclical industries. You definitely look into financials, energy, and off late, you can clearly see other sectors like consumer services, staples, healthcare, which consider very defensive sector by nature. You can see there's a lot of fund flow into these sectors as well. So what this goes to show is that consumer is actually getting very cautious. Despite we are seeing all-time highs in indices, a lot of these sentiments are slowly starting to shift to going into a bit more into defensive sectors. In anticipation that the market might correct to a certain extent, but eventually I think these are defensive sectors could benefit in the medium term. So this again shows an indication that generally the market participants are quite cautious going forward, especially we're heading into the third and fourth quarter. So again, it's good to pay a close attention to as where to the fund flow is, and where are these big funds moving into. Now, I do get this a lot, especially when it comes to looking to US major indices. If you just look at Dow Jones or even S&P 500, we are almost reaching all-time high for many days right now. Just yesterday, we had just a good correction in the market. Now, if you just look at composition of the S&P 500 in terms of the market cap, you can clearly see it's mainly dominated by 5 major firms, which is clearly your Google, your Apple, your Amazon, your Facebook, your Microsoft. So these 5 companies alone almost contribute 30% of your total market cap in the S&P 500. So any major movement in terms of these respective stocks will definitely have an impact on your indices. Now, you just look at meteoric rise in terms of the market cap, it's actually tremendous. I think if you just look at Apple market cap itself, probably 5 years back, it was probably less than $1 trillion. Right now, you're almost approaching $3 trillion US in terms of market cap valuation. So these 5 big companies is having a heavy constitute in the S&P 500. But again, every valuation needs to be justified. So if we just look at their profit potential, it's still very robust in a sense. Even their sales figures are still very robust. Given that right now we are in a pandemic situation, a lot of services sectors are going offline and going into internet, where they will definitely benefit these 5 major firms. But what's important is that valuations, if profits are not fast enough to catch up with valuations, I think there are definitely going to be adjustment. But no, whenever we trade US indices, it's important for us to take note of these 5 major companies. Now, I think in terms of fundamental perspective or in terms of the narrative optics, there's definitely a couple of headwinds that we are going through. Especially when you look through seasonality, September, October period usually is not a good period when it comes to autumn in the equities market. So I think one of the major headwinds in the US market is definitely going to be a debt ceiling issue that's going to resurface coming October. So, you know, in 2019, they struck a deal under the President Trump. So that ceiling was actually raised to 22 trillion. And obviously, it was need to be rediscussed in 2020, but it was delayed because of the COVID-19 pandemic. So it was definitely readjusted to 28.5 trillion as of now. So, you know, I think if you just look at the politics in US itself, it's going to be very messy. No, there's definitely deliberations that need to be done right now before we head into the first week of October. Now, if you just look at the current sentiment, the Senate is split 50-50 down the middle. So it's actually anyone's guess. And what is crucial is that President Biden actually proposed a very big, massive spending budget, which costs about 3.5 trillion US dollars, and that's going to add into the total debt again. And I think there's a likelihood that President Biden might face a bit of difficulty in actually getting the Senate to approve the budget. But nevertheless, debt ceiling issue could definitely resurface. And if there's no middle ground achieved, there's no agreement in place, definitely we will look into a possibility of a government shutdown eventually, and that's going to have an impact in the market. So again, I think we are heading into a very volatile period in terms of market, and I think that's where opportunity can we can definitely find opportunities to trade with. Now, I think this is very interesting optics here. If you just look at options contracts on the US major indices, you can clearly see the volume has actually increasing off late. There's rising participation from the market. Now, what is interesting is that most stock options in US actually expired on the 3rd Friday of every month. Now, I think one of the major reasons why you can see the big rising volume in options market is because we have a lot of new generation of traders in the US markets, and these young new traders, they love leverage, and options does provide a very high leverage instrument. So therefore, I think that explains why we can see rising volume in the options market. Now, this rising volume, it does create a certain impact into the market. If you look at the recent performance in the S&P 500, if you notice every middle of the month, you can see a sharp sell down, especially towards the 3rd Friday. Reason being is because once those option contracts expires, market makers or even some hedgers will really go into the cash market to hedge out those positions or to clear those positions, and definitely you can see impact in terms of the prices. So it's been a repeated pattern. I'm not going to say that it's whether it's going to repeat in the upcoming weeks, but it's worth to pay attention to, because the behavior of the market does indicate that we might see this kind of tendencies as we go forward. So mid-month weakness due to the options market might have an impact because of the recent rise in options market. So do watch out whether it will resurface again. I think that's pretty much to be seen, but it does give you a gauge on how the overall market is going to behave, especially when it comes to the middle of the month. Now, seasonal tendencies on Dow Jones actually is very peculiar in nature. So if you just look at the table on the right, which shows that the Dow Jones performance for the 120 years, and if you just look on the monthly basis, you can clearly see as we head into September, October period, just right after summer, you can clearly see that market generally does not perform well. The rest of the other months has been the strong performing month, but when it comes to September, October, usually you will see higher volatility, and usually it's a weaker month. And if you just look at the colored table, the green and red bars, you can clearly see that September usually is a period where for the past 20 years, it has been a 50-50 split, which means that there's a 50% chance that it might end in a negative position, month-to-month basis. So again, if you are trading in this market, we have to be aware of seasonal tendencies, because this will have an impact, or it does create a certain bias to your trading decisions. But we should not use this as purely as a trading tool, but we should use this as it helps in our trading in terms of forming a bias. But no, as I think what history has shown, as we head into September-October period, is we should see higher volatility periods. And as a trader, I think that's definitely going to be something that we should look at, because high volatility is something that we could capture quite a lot of opportunities. Now, if you just look at S&P 500, it's a very similar fashion like Dow Jones. Indeed, again, September-October period is where you can see more volatile periods in terms of prices, and that's where we need to be very careful of as well. Now, if you just compare the 4 major indices in the US market, clearly the outperformer is Nasdaq, followed by your S&P 500, Dow Jones. But if you just look at the small cap index, which is your Russell 2000, you can clearly see that it has been in a consolidation mode for quite some time. So really, the performing stocks in the US market generally has been the big tech companies. As I shown earlier, the big 5 tech companies really was the bellwether for some of the US major indices. So it's crucial to watch their performance, especially in terms of their profit potential and their sales potential. Whether could they repeat strong performance into a coming quarters. So I think that's something for us to take note of, especially when you're trading these markets in general. So that's pretty much on some of the fundamental aspects that we need to be aware of if you are trading the US indices market. And key data, key variable does paint you an overall sentiment of the market. So it does give you a feeling of where the market is going to head to. Are we going to go into a better economic scenario, which eventually will relate into higher stock prices? So I think that's something for us to view as a sentiment. Now onto the second part, which is the technical trading aspect. So I think one of the key things is when you look into a technical side of things is if you just look at the key tenets of technical analysis is to look into Dow theory, which indicates that you can look at the overall trend of a particular market or a product by just looking at the peaks and troughs. So when you have higher peaks and higher troughs, that's usually indicate the market is generally on an uptrend. Vice versa, if you see lower peaks and lower troughs, generally the market is in a downtrend. And if those peaks and troughs are actually very similar level, that means the market is on a sideway. So by graphical representation, we can distinguish whether the particular market is on an uptrend or downtrend by looking at the peaks and troughs. So what I have here is a very fascinating chart. You can clearly see there's 2 series of trends here. One is a series of uptrend, which is indicated by higher peaks, higher troughs, followed by a series of a downtrend, which is indicated by lower peaks and lower troughs. So one will guess like what type of instrument is this? And so it is fascinating. Between a span of total of 4 months, it went up to as high as double the price. And within a short span of 1 month, it actually went back to its original price before the rally. So it shows you that as every trend, you tend to face exhaustion, and we have to be very mindful of when the trend exhausts itself, and that's usually will indicate a lot of signs that the trend might change. So just for the knowledge of our audience, this chart is actually representing the price of lumber on the CME exchange. So we saw lumber prices actually on a massive rally, especially early part of this year. But that quickly faltered as actually resulted prices actually revert back to its original price before the rally. Now, besides looking into trend on a graphical manner, you can also use a 200 period EMA line, exponential moving average, as a way to depict the overall trend of the particular market. So as long as prices is trading above the 200 EMA, it does indicate that the prices is on an uptrend and is well supported by the long-term moving average period. And if the prices are trading below the 200 EMA, it does indicate that prices is actually on a downtrend and it's trading below the 200 period EMA. So a market consensus would like to, a lot of market participants would like to use this 200 period EMA as a line to define whether the market is actually trading on a positive note or negative note. Because 200 period EMA signifies about 9 to 10 months worth of trading data. So that can show what's the long-term view of the market at the moment. So you can clearly see based on S&P 500 is still well above the 200 period EMA. And not only that you use 200 period EMA as a way to identify trends, it also can be used as a supporting support as well as resistance line. So you can clearly see there's always, whenever there's movement be above or below the line, usually it signals that the trend will change. So it's clearly evident here when the price back in early March 2020, when prices broke below the 200 period EMA line, technically it broke the support and it went all the way down. So not only it does signifies the overall trend of the market, it also provide you a major support and resistance level based on the 200 period EMA line. So if you just use this convention, if we just look at some of the major US indices, a lot of this currently a lot of major US indices are actually trading above the 200 period EMA. So again, it again shows that generally the US indices is trading on an uptrend. Now, besides using Dow theory as a way to look into a trend graphically, as well as using 200 period EMA line to distinguish whether the market is on the uptrend or downtrend, it's important for us to know whenever you look at the trend of the market is to see whether the trend can continue or is going to face exhaustion. One indicator that we can use is Adx Aries directional index, which goes to show that whenever you see rising Adx value, generally you tend to see the trend is going to continue higher if it's an uptrend, and if you see Adx value rising on a downtrend, it indicates that the downtrend will likely to persist even further. So when Adx value is generally very flat, that means the market is on a sideways market. So you just look at this latest snapshot I got from S&P 500. You can clearly see even though we are seeing a major uptrend in the market, but that trend is facing exhaustion. Because you just look at Adx value, it has been actually very flat. So do watch out, especially when Adx value start to rise. S&P 500 will have a tendency to form a trend, whether it's on an uptrend or downtrend. That's where we need to be in the market. But right now, if you just look at Adx value, it does indicate the market is actually on the consolidation phase and is trading on a sideways market. Despite, if you just look at the overall trend of S&P 500, it's still a major uptrend. And you just look at Nasdaq. Nasdaq just broke all-time high, and you just look at the Adx value, it starts to rise. That indicates that the recent uptrend might have some leaks. But when Adx value starts to go flat, I think that's where we also should see exhaustion in the Nasdaq market as well. So just a basic classification of Adx value, if you're using this as an indicator for you to determine the strength of the trend. So when you have value, so Adx trades with a value of 0 to 100. So you have a value of 0 to 25 indicates that the trend generally is a weak trend or is a consolidation trend. And when you have value that's above 25, usually indicates that the trend is forming, and the trend will get stronger. And anything, any value that's above 50 to 100 is to indicate the strength, the momentum is there, the trend will likely continue. Now, besides looking into Adx, the strength of the trend, it is important for us to be able to identify positions for us to enter and exit. I think one of the ways that I would personally like to use is to look into Heiken-Ashi as a way to determine the areas for me to enter and exit from a particular price level. So if you just look at Heiken-Ashi candles, it's slightly different from your Japanese candlesticks, because Heiken-Ashi is taking the middle bar or the average bar of your Japanese candlesticks. And if you use Heiken-Ashi, you notice that the gaps are usually taken off, and it's only concentrating on the color of the bar. Now, the reason I chose Heiken-Ashi as one of the base of a setup is because if you just look at Japanese candlesticks, there's so many type of formation that you need to be that you need to know. There's 100 over configurations, but if just Heiken Ashi itself is simple. It's just only 3 simple basics configuration. So if the first configuration is you have a colored bar with a top and down wick, that usually indicates that the trend is actually weakening. And when you have a candle bars with only one wick at the top and at the bottom, it usually indicates that the trend will likely to continue. And when you have a very small body candle, that usually indicates that the market is indecisive, and that usually indicates the market is going to reverse or consolidation. So this is generally very simple. If you just look at the 3 distinct types of Heiken Ashi candles configuration, that's able for you to identify whether the current market is on an uptrend or downtrend. So you can clearly see red colored candle bars usually signifies downtrend, green colored bars usually signifies uptrend. And whenever you see a bars that is like dodgy type, very small body, that usually tells you that the trend may be exhaustive, and that's where you need to be careful. So again, to illustrate the simple illustration between Heiken Ashi and Japanese candlesticks, so with Heiken Ashi, you can clearly see the strength of the trend or the trend itself more distinctly as compared to Japanese candlesticks. And Japanese candlesticks, sometimes you do tend to get a lot of sideways market, and that's where it generates a lot of signals. So that's you tend to be in and out of the market quite often if you use Japanese candlesticks. But if you use Heiken Ashi, as long as the trend is still showing you colored bars, you still stay on to the trend till the trend ends. So again, just to highlight the Heiken Ashi dynamics, when you see green color bars, usually it tells you the market is on an uptrend. As the colored green bars get wider, get bigger, that usually tells you the trend of the strength is strong. Same goes for downtrend. If you see red color candle bars, that tells you that the market is on a downward trend. And as those candle bars get wider, the body gets wider, that tells you the trend of the downward strength is going to be strong. So that's why you need to be careful as well. So just to put into perspective, if you combine ADX as a strength of a trend indicator together with Heiken Ashi, you just get a fairly good signal. So if you see a green color bar in Heiken Ashi, that tells you that generally the market is going to hit higher. And if you just look at rising ADX value, that tells you that the trend is likely to stay. Now, one thing to take note is that if you just look at ADX value, when it comes from a flat period, generally, it does tells you that the market will likely go into a trend phase. So in this case, it was actually a red color candle bars, it was actually a downtrend. And with rising ADX value, that indicates that the downtrend can still continue. So it's good to accompany Heiken Ashi with ADX indicator as a way for you to measure the trend of the strength. Now, I also do incorporate moving average crossovers as a way to perfect the indicator better. So if you look at it, in moving average crossovers, I use a 9 period against a 20 period EMA. So moving average crossover is actually fairly simple. If you have a bullish crossovers, which means that the shorter term period, which is the 9 period EMA, crosses above the longer term 20 period EMA, that tells you that the market generally is quite bullish. And that signals by the green colored Heiken Ashi bar, that's usually the position for you to enter. And vice versa, if you have a bearish crossover, which is the 9 period crossing below, and accompanied by red candle Heiken Ashi, that usually tells you that the market is going to go on a downtrend. And that usually will be a signal for me to short the market. Now, the 9 period and 20 period EMA does provide you a fairly good level of resistance and support areas. So not only the crossovers is important for you to tell you where are the positions for you to enter and exit, the EMA line itself provides you areas where the candles tend to be supported and the areas where areas of the lines where it tend to be resisted as well. So not only it does give you an indication of crossovers, it also acts as a support and resistance level for you to indicate. So it goes fairly well, especially when you are trading on the shorter time frame. It is important for you to take note where, especially when candles are approaching those EMA period lines, and that's where you need to be careful as well. So I think once you accompany that, you have the moving average crossovers, you have the Heiken-Ashi candle bars, and you accompany that with ADX. I think it does give you a fairly good signal in a way for you to enter into a particular market, especially when it's trending. And it also does indicate to you when the market is tend to be exhausted, especially with ADX values start to decline, and that's where you need to be out of the market. So I think with this setup, it does give you a fairly good coverage in terms of going into the particular time frame and to time points where the trend would start to form and points where the trend starts to decline. Last but not least, I think with every trade setup management, we really do need to have a risk management in place. And one of the good tools that you can use, especially to manage your risk, is what we call Aries True Range Indicator. Now, the ATR basically tells you the high and low of a particular period. And as long as when you have volatile period in place, you really do need to prepare to put your stop loss on a bigger level, because when markets gets volatile, if you don't manage your stop loss well, you tend to get stopped out very easily. So ATR does give you a good reference point as to at which point you should be placing your stop loss. So just take it for example, we have in this good long setup, evident by a bullish average crossovers with a green Heiken-Ashi bars. So that's a good position for you to enter a long position. So assuming you enter long position at 4,448 and with a target profit at 4,460. Reason being, it's if you look at ATR at that point, it's about 7 points. And if you work on the risk to reward ratio, you want to be rewarding yourself 2 to 1. So that means you are taking 14 points profit with a 7 points loss level. So that's how you manage your stop loss position using the ATR. So it's important for us to take note, as when volatility starts to kick in, your ATR value will start to increase, and that's where you need to manage your stop loss on a wider basis. Because if you have a fixed stop loss, and if it's not dynamic to the market sentiment, you would tend to get stopped out at every single time, and that's going to be very frustrating if it will eat up to your capital and eventually to your cost as well. So it's another example. Here we have on Micro E-mini Nasdaq. Again, you have a bearish crossovers on the moving average, and you have a red Heiken-Ashi. So it's a setup for a short side. And you just look at the ATR value is about 20 points. So if you work on the reward to risk ratio 2 to 1, so you are willing to risk 20 points for a profit of 40 points. So that's how you manage your risk by using the ATR values. Okay, so I think towards the end part, I think importantly, if you are new to the market, with the launch of the new suits of CME suits of Micro E-minis, I think it's provide you a very good platform for you to be starting to be in the market, given there is lower margin requirements. And if you just look at volatility itself and the volume itself, has actually been tremendous. It's actually picked up quite a lot. So it provides you a very good opportunity, especially for traders who are new to the market. So I think just to re-emphasize some of the key points, on why we should trade the Micro E-mini futures, or to begin with the Micro E-mini futures, is because now just before the launch of Micro E-mini, a lot of retailers find it difficult to get exposure into the US indices, given for the fact that the margins requirements is actually pretty heavy. Now with the new launch of Micro E-mini futures, it does give a lot of leeway, especially for new traders who might not have that much capital but wants to get a taste for the market. I think Micro E-mini is the best platform to start with, because of the lower margin requirement. Now, obviously, I think with every new product, a lot of traders, the first issue they face is always about volume. But if you just look at since the launch of Micro E-mini for the past 1 year, you can clearly see volume has actually been very, very good. You just look at Micro E-mini S&P 500. Averagely on daily basis, you're looking at about 1 million contracts, and that's very scalable. So with good liquidity, there's obviously no issue about cost or cost of coming in and out of the market. And with such a small product, is 1/10 of your normal contract size. It does give advantage for traders to actually scale to certain size. So obviously, as a new trader, you start off with one lot, because it's a small contract. Then if you want to increase the size, you can obviously size up to 2 or 3 lots easily. So it does give you a bit of scalability in that sense. So I think as a trader, you're new to the market, you'll always be fearful of the market whenever you first do a live trade, because that's involving live capital. So being stuck in paper trading for a long period of time will be very disadvantageous and quite demotivating. So I think with this Micro E-mini, it does give you an advantage in the sense that it does give you a real market exposure. I think other aspects of trading which is important, which I did not emphasize here, is obviously money management is very key. So always emphasize stop loss. Without stop loss in place, you are just putting yourself into too much risk into a position, which is not recommended. And I think as to any new traders that's in the market, you need to identify what type of traders you are eventually, whether you are a scalper or intraday basis, or whether you are a swing trader or you are a long-term trader. So I think the type of traders you are is actually defined as to the type of individuals you are as well. So it's important for us to define that, especially when you are new to the market. So risk to reward ratio is important. Last but not least, which I couldn't cover much in this webinar, is psychology aspect of trading is definitely a key element for trading success. I think regardless whether you have whether you're the best tool, best setup, importantly is still the psychology and the mental strength of a trader that determine his success. So conclusion, I think obviously there's a lot of seasonal tendencies when it comes to the US market. We are heading into some of the months which is obviously very weak months. So that's where you need to be very careful. And again, volatility is going to be there as well. So again, we have to be very mindful of these tendencies which always re-emerge every single year. There's a lot of headwinds in place. One of it is debt ceiling. Obviously, the looming Fed tapering is eventual. And I think this was slightly not mentioned in some of the key market analysis. We are all assuming that Jerome Powell will get re-elected, but obviously there's still a re-election risk. I think his contract will be up by next year February. So obviously we don't want too much of uncertainty. We want certainty. So I think this is going to present as a headwind as well. Risk of stagflation is going to be there. But nevertheless, as a trader, I think the trend, we always want to be trading with a trend, because the business of trading against a trend is never a good business to be in. So as long as the overall trend is still intact, we should be trading with a trend, and we should be very observant when the trend changes by looking at some of the key variables that can affect the overall market. So with that, I'm just going to end here. I'm just going to pause for the next 30 seconds for any questions that you may have, as we go through some of the questions and answers that you may have. Okay, I'm just going to go through some of the questions. So if you have any questions, please feel free to type in the question box. I will do my best to answer those questions that you have. Okay, the first question is, how do I get the margin depth data as shown? Well, you can get that margin data from FINRA. They do publish the margin depth data every monthly basis. I'm not sure when's the date, but you do check out every month on FINRA website. You can Google it if you couldn't get it, but they do publish it on a monthly basis. Okay, next question. Within next 6 to 12 months, US or China or Asian markets has a higher potential for stock price appreciation? Wow, this is a very good question. Now, I think the risk is still very dominant in terms of the US market, or rather the Asian market for now. But no, recent narrative, especially in China market, has actually caused a lot of investors or traders to actually be very worried. So the only good side that we can see, the good market that we can see for now, is actually the US market. So next 6 to 12 months is very crucial to watch how US market is going to perform. I still think that those big tech companies can still perform well, given that this COVID crisis is still very imminent and still very profound. So I think their profits still going to be strong in a sense. So those US market can continue to perform well. So I still see there's more glimmer of hope in US market, but nevertheless, I think China, given if there's clarity going forward, especially in terms of that policy, we should see China rebounding strongly as well going forward. Okay, next question. Do Fed tapering advantage to stock market? Now, this is very debatable. If you just look at historical, we just last have a Fed tapering in 2013. That was not comfortable with the stock market at all. Whenever Fed decided to taper, whether it's withdrawing liquidity from the market or hiking interest rates, it's going to have an impact in terms of the stock market. So obviously, as I mentioned earlier in the slides, I was saying that September likely to be a period where it's likely to taper, but I think that's not going to be the case. Most likely, we are looking into probably November, where the taper will likely to begin. But then again, dynamics can change. But generally, I think Fed tapering is not going to be something that's nice to the stock market overall. Okay, so how do I find ATR in TradingView? Okay, so you can find ATR in TradingView by just typing average true range. That's the full name. Okay, hi. How do we use default setting for ATR and ADX? So in my trading setup example, I use the default setup. I don't change the ATR value or even the ADX value. Now the thing is that is it better to use default or to use other settings? We don't want to be in a position where we keep changing the settings to fit the curve for the graph. Then in a sense that we involve ourselves in curve fitting, and that will run the risk. So I think I'm comfortable in using default settings. Obviously, when things start to change, I think that's where I need to look into other factors and consider that. But for now, I think ATR and ADX, which I shown earlier, is based on a default setting. Okay. There's one question. Your EMA is using how many days? So my EMA is actually based on the 9-period EMA against the 20-period EMA. So it's 9 and 20. Okay, there's a couple of questions on platform as well as minimum capital. So I'll just leave these questions for Phillip Futures representative. You can obviously reach them. You can give them a call, and they'll probably be happy to assist you, especially when it comes to platform as well as capital requirements. Okay. Can the technical method be used to trade FCPO and FKRI spreads contract as well? Wow, this is a good question, but it's slightly off topic for today's presentation. I just want to address in a way that whatever I shared in terms of technical setup is a basic setup. It's a good start if you are new to the market. Again, different markets will have different type of setup because the nature of the market itself is different. If you trade US indices and you want to apply the same thing on let's say on a FKRI market or FCPO market, it might differ differently because it's a different nature altogether. So I would say in short, it might not work on a specific market besides the US indices market because it's a different nature altogether. Mind to share how much does it cost to subscribe Bloomberg Terminal as shown on the PowerPoint. Now, this is a very good point to bring up. Again, I think I got help from a few friends who have access to Bloomberg Terminal. I myself, I do not subscribe for Bloomberg Terminal because it does incur quite a costly cost per month. So a lot of my presentations, I do get it from some of my friends who have access to Bloomberg Terminal. Okay, hi, can you explain one more time on how to use ADX? So ADX full name is actually average directional movement. So you can get that as the indicator's name. So you probably can get it from any of the trading platform. So I'm just gonna, due to the constraint of time, I'm just gonna answer one last question here. And if any other questions, I think feel free to reach Phillip Futures personnel. They will probably be happy to assist you. So the last question is, I'm interested what is your lower time frame to enter markets? Now, this is a very good question. If you just look at the time frame that I use, most of the time I look at I use a time frame analysis. So what I do is that I'll look at a daily chart basis. I'll look at where the daily trend is going to go, and from there I shrink it down because I'm more of an intraday trader. I'm not a scalper, or swing is generally doesn't constitute much of my trading style. I'm generally still an intraday trader. So I usually look at a daily pattern first, which is the daily time frame, and I go it down into, I'll probably reduce it to 4 hourlies and to hourly chart. And to sometimes when the market is very trendy, especially when you have a data announcement or there's a market developments, I probably will reduce it down to 30 minutes, and that's the lowest time frame that I'll go. Yeah, so I hope that answers your question, and I think that's pretty much on my part. I will hand it over to Abigail.
All right. Thanks, David, for your insightful sharing on the fundamental and technical aspects of the US markets. I hope everyone have learned something valuable tonight. For questions regarding capital required platform and also account opening, we will get our representative to contact you as soon as possible after this, yeah? And yeah, so I think with that, we have come to the end of our webinar. And thank you once again for joining us, and we will see you all again next time. Take care and stay safe. Bye-bye.
Okay, thank you and stay safe.